Hello and welcome to the State of Student Loans Part 2 webinar. If you are someone who is in the room live and you are watching slash listening to this recording and it seems like a different format, it is because we had some trouble with last night's recording. The main trouble being that I forgot to record it. So we are back here for round 2 of the same webinar, the State of Student Loans. We're re-recording it, and thankfully I do have the questions from last night to make sure that we are answering everything that you had to ask last night, and also that if you paid for the question and answer, that you will receive that information. Now, unfortunately, the one thing that did carry over from last night is I still have no voice. So my apologies again. Bear with me, doing everything I can, drinking the water, sipping the tea to make sure it gets better. So please bear with me. But let's get into the State of Student Loans Part 2. Before we even get into the state of student loans, I want to remind you of some ways that you can advocate for yourself when it comes to misleading information or inaccurate information that you are given when it comes to your federal student loans. When you are contacting a student loan servicer, it may sound odd to say, but you have to understand that there's a good chance that when you reach out to a servicer and are talking to a customer service representative, that if you have been keeping up with student loan regulations and updates for any significant period of time, you may know more information or more accurate and up-to-date information than the person helping you on the call. That is a consequence of the fact that there's limited resources to hire these people. And by the time you would put together any training program on a student loan regulation, what they are learning is probably already outdated. That is the pace at which things have been occurring over the past couple of years when it comes to federal student loans. So it is possible that you could find yourself in a scenario where a student loan servicer is doing something to you or has told something to you that is inaccurate that causes harm. And if that occurs, you want to know how to advocate for yourself. One of the ways that you can do so is to make sure that you document everything. So anything that you're told over the phone, I would encourage you to require that person to send you an email or to send you a fax. Or if you are sending documents, maybe if you're mailing it in, you mail it certified mail. But anything that you can do to make sure you have a trail of supporting evidence, I would encourage you to do so. You also want to make sure that when you are reaching out for help, that you have already researched the relevant Department of Education guidelines. So before you even call, you want to be armed with information from studentaid.gov to support your case. And in the event that you have done that, you've documented everything, you have the relevant guidelines, and still something occurs that is counter to those guidelines, the two main recourses that you have are the Consumer Financial Protection Bureau and the Student Loan Ombudsman. The Consumer Financial Protection Bureau is a third party, but it advocates for consumers. And if you can find documentation that supports your claim, they will investigate it just like a credit bureau would investigate if you filed a credit dispute. Now, conversely, the Student Loan Ombudsman actually is partnered with the Department of Education. They are your internal resource to make sure that student loan servicers are following guidelines. Or if the Department of Education has harmed you in a way, the Student Loan Ombudsman is your recourse to make sure that it's rectified. And we have seen a lot of success with people who were told something incorrectly or had, a payment drafted incorrectly or not adjusted based on relevant guidelines. And the Student Loan Ombudsman has been successful in correcting those cases. So you want to make sure that you are documenting everything, finding the relevant guidelines, and when necessary, advocating for yourself with the CFPB and also the Student Loan Ombudsman. Next, let's talk about updates to income-driven repayment plans, in particular under the federal student loan umbrella. If you're listening to this, you have private student loans. There is a section where we will discuss private loans. But for right now, the bulk of the changes that we've seen over the past few years and definitely the past several months are related to income-driven repayment plans. And when we talk about those updates, it's important that we separate them into two camps. We've talked about this on the Escape Student Loan Debt podcast. But there are two different camps of income-driven repayment plans. There are plans that were created by Congress, and there were plans that were created by the Department of Education. Now, the common thread of any income-driven repayment plan is that payments are based on a percentage of your discretionary income. When it comes to the most popular plans that are going to be around, that percentage is either 10% of discretionary income or 15% of discretionary income. And there is no limit to how much you can have forgiven under these plans. If you are not paying enough to pay your loans off in full, then depending on your plan, after 20 or 25 years of payments, remaining balances will be forgiven. This podcast doesn't exist to be political, but if you're looking at what happens when it's forgiven, prior to the Trump administration, if you had federal student loans forgiven, those forgiven loans were taxable as income in the year of forgiveness. An example would be if you earned $100,000 and in that year you had $200,000 worth of student loans forgiven. From a taxable income perspective, it would make it look like you earned $300,000, which can lead to significant taxation. Now, until the year 2026, there has been a reprieve from that where there is no taxation on forgiven student loans. This is a likely scenario where this incoming administration would probably extend that so that I would expect there to not be taxes on forgiven student loans for the foreseeable future. So those are the common threads of all income-driven repayment plans. But when it comes to breaking those into the two camps, you want to look at the Department of Education plans, which were the pay-as-you-earn plan, the repay plan, which later became the SAVE plan, and income contingent repayment. The congressional plans were the old and new versions of the income-based repayment plan. So let's first start with the SAVE plans and the Department of Education plans. When it comes to SAVE, we've talked about this many times, that plan is almost certainly done for. We're not going to get into the background when it comes to what's going on with the SAVE plan in the courts. Just know that to this point, courts have agreed with states who have sued blocking the SAVE plan that it is illegal. And the only thing that was keeping the fight going was a Biden Department of Education that wanted to see the SAVE plan go through. In the absence of that Department of Education that wants to see the SAVE plan go through, and the Trump administration has already signaled that they do not, they will likely just drop those court cases and the SAVE plan would be no more. And when it comes to the current status of people who have already signed up for SAVE, if you're on this plan, you're aware that you're currently on administrative forbearance. That administrative forbearance is something that, based on the Department of Education announcements and communications, will last a minimum of an additional 6 months at the time that they announced it. That was a month ago, so a minimum of an additional 5 months. Not saying 5 months, saying a minimum of an additional 5 months. Now, one of the things that the incoming administration has already signaled their distaste with is the number of delays when it comes to kicking student loan payments back up again. So there's always the possibility that the new administration could cut that payment time in terms of when you start paying again. But if we're going to go based on the idea that there is right now no clear alternative or path out of SAVE for people who have signed up, it is not unheard of for that 5 or 6 months to be a very realistic timeline. The unfortunate reality of that administrative forbearance is you are not getting any credit towards PSLF or income-driven repayment plan forgiveness when it comes to the 10 years that are needed before forgiven under PSLF or the 20 or 25 that are needed under the various income-driven repayment plans. Let's talk about the pros and cons of staying on SAVE so that you can continue with the administrative forbearance, or the second option, which would be to come out of SAVE and sign up for another income-driven repayment plan. Now, the obvious pro to staying on SAVE and administrative forbearance is that you're not making a payment. So if you have other financial priorities, you're trying to pay down debt, whether it be credit card debt, a car loan, any other debts that you may have, or maybe you're trying to stockpile your savings or put money into investments before payments start up again, then obviously having no payment is a good and big deal. The other benefit is right now, while you're under SAVE administrative forbearance, if you've been on income-driven repayment plans in the past, you're aware that once a year, your student loan servicer reaches out to you and asks you to recertify your income so they can recalculate your payment for the upcoming 12 months. While you're on administrative forbearance, that's not something that you have to worry about. So if you've had a significant income increase since the last time you recertified, which for many people was 2018, 2019, then taking advantage of this administrative forbearance could prevent you or delay you from seeing a significant jump in payments. Those are the pros. The cons, however, is obviously you're not getting any progress towards forgiveness. And also, there's a potential that you would miss the window to sign up for the pay-as-you-earn plan if you are eligible, which you're going to talk about in more detail in the next few slides. When we talk about those other plans under the Department of Education, the most popular of those plans was the pay as you earn plan. And the problem with the court case that you're seeing with SAVE is that part of the argument, which I will say, unfortunately, I think is a valid argument, is that the amount of money that would be forgiven under SAVE constitutes spending money. So when you see something happen in this country where there's significant money spent by the government, technically, in most cases, it's supposed to be approved by Congress. So what they are saying is not only should this have been approved by Congress, but the entire element of forgiveness that was created by SAVE or revised pay as you earn or pay as you earn or income contingent repayment is something that's unlawful for the Department of Education to create without congressional approval. So that means that if they are successful in proving that the creation of SAVE was unlawful, then depending on how thoroughly they wanted to attack the other income-driven repayment plans created by the Department of Education, there's a possibility that all of those plans are at risk, leaving the only plans available under IBR as the old and new version of income-based repayment plan. What the Department of Education did in response was, if you've been keeping up with the podcast, you know that the pay as you earn plan is something that was actually phased out of the available options in 2024. What they said was, if you hadn't signed up by July 1st of 2024, then it was closed to new borrowers. And it was something that you couldn't retroactively, even if you would have been eligible, go back and sign up for. And since the department can now see that the SAVE plan is about to be dead on arrival, they have temporarily reopened the window to sign up for SAVE through July of 2027. Again, an incoming Trump administration could just say that they're closing that window. But if you're going to use the past as prologue and evidence of what might happen in the future, even though there's no guarantee, typically what would occur in those scenarios is they would grandfather in people who had already signed up. They would not close the window and then go back to people already on pay and kick them off of pay. So if you're going to take the chance and you think that the pay plan is going to be the right plan for you as compared to your other alternatives, this temporary window gives you an opportunity to sign up for pay before that window is closed and have an option that might save you money and save you time. So let's talk about the details of the pay plan. All of these details are available in our Escape Student Loan Debt Guide to Income-Driven Repayment Plans, which if you have paid for this webinar, you will have access to in the recap email. The pay-as-you-earn plan only allows you to pay towards direct loans. If you have any loans that are not direct loans, you can make them eligible by consolidating them, but only direct loans are eligible under pay-as-you-earn. In order to be on this plan, you have to be what's considered a new borrower as of 10/1/2007. That means that you either do not have student loans or you had paid off your student loans prior to that date. And you also have to take an additional loan after 10/1/2011. Now, there's a small group of people who are eligible for both the pay as you earn plan and also the old version of the income-based repayment plan. Now, if you're eligible for pay as you earn, and this is an important group of people, because if you're eligible for new income-based repayment, then it's not really that big of a deal that you miss a window, whether temporary, not temporary, what have you. Because the new version of income-based repayment is almost identical to the pay-as-you-earn plan. But if you're eligible for pay-as-you-earn and old IBR, the problem is that old IBR is not as forgiving as pay-as-you-earn. Now, what is that window of people? For pay-as-you-earn, you're eligible for old income-based repayment as well if you are a new borrower as of 10/1/2007. In that window, you have to also sign up for a new loan after 10/1/2011. And really, if you have borrowed up to about July of 2014, that's the window of people who are eligible for both pay and old IBR. And if you're comparing the two, there are some similarities. Both of these plans require what's called a partial financial hardship, which we'll discuss later in this podcast. And if you do not have that partial financial hardship, then both of these plans will revert your payment to the payment required under the 10-year standard plan. But that's where the similarities end, because the pay-as-you-earn plan only requires you to pay 10% of your income towards your student loans, while old IBR requires 15% of your discretionary income. So 5% more in terms of what you're paying. And in terms of how long you pay until any remaining loans are forgiven, old IBR is 25 years of payments versus 20 years under pay-as-you-earn. So you're paying 5% more for 5 years longer. And these numbers can really, really add up. If you're looking at the payment example on screen, if we had a single person who had an adjusted gross income of $100,000, then under pay as you earn, they would pay $645 a month. Whereas under old IBR, it would be $967 a month, over $300 a month more for an additional 5 years. And while we're on the subject of things that are potentially under attack by an incoming administration, let's go through all of them. So what's safe versus what's under attack? If you're following along on audio, we have a slide up on the screen right now that shows you what's safe versus what's at risk. When it comes to the things that are safe, public service loan forgiveness is safe. Without getting too deep into the details, it would require a significant majority of the Senate to vote to do away with public service loan forgiveness. They've tried it in the past. It has failed miserably because the amount of majority they would need will require both moderate Republicans in swing states to join with them, and also some Democrats, which is just not going to happen. So public service loan forgiveness is safe. Also, because the income-based repayment plans and the forgiveness offered under old IBR were created by Congress, it would require a similar majority. And that's also something that I don't see occurring. Them closing off the ability for you to have your student loans forgiven at all is not really a good political maneuver. So public service loan forgiveness and at least having two options for income-driven repayment that offer forgiveness are things that are safe. You also will see that, in my opinion, there is no scenario where the one-time adjustments to your credit under the PSLF waiver and the IDR waiver, I don't see a scenario where they can claw that back. It would require too much effort, too much coordination with loan servicers to find information that, in my opinion, would be impossible to find. So if you have either had your student loans forgiven already as a result of that waiver, I see no scenario where they claw back that forgiven debt. Or if you've gotten yourself significantly closer to forgiveness, I see no scenario where they can reasonably go back and find an amount of credit that they should kick you back to. So those plans are safe. Now, when it comes to what's at risk, public service loan forgiveness buybacks are, to me, definitely on the chopping block. As a reminder, public service loan forgiveness is something that requires 10 years worth of payments while working for an eligible government or nonprofit employer and paying your student loans back under income-driven repayment plans. And for various reasons, there are scenarios where you might have worked for an eligible employer, but you decided that you weren't going to pay your student loans during those years that would have counted had you paid. Public service loan forgiveness buyback program allows you, if you can prove that once you have those past credits that you didn't receive, you would be over the 10 years needed to have your student loans forgiven. It allows you to go back and calculate what you would have paid during those years and just pay it to the Department of Education now and have your student loans forgiven as a result under public service loan forgiveness. And this is not a program that I see being looked upon favorably by the Trump administration. That is projection, but in case I'm right, if you are eligible for public service loan forgiveness buybacks, which really just means that you had student loans while working for a nonprofit or a government employer for at least 10 years, then I would definitively go through the process of signing up now. In this email with the recap for the webinar, we're going to include resources for how you can go through studentaid.gov and submit a request for public service loan forgiveness buybacks. But that is something that I would do yesterday if I was eligible for public service loan forgiveness through this program. In terms of other things that are at risk, we've talked about the SAVE plan. I have an asterisk on the screen next to the Pay As You Earn plan and the Income Contingent Repayment plan, those being the other two plans that were created by the Department of Education, and also the Biden forgiveness programs. There's no need to even go to the details. If there was a major forgiveness program that was introduced during the Biden administration, that program is not going to happen. And some other considerations that you want to keep in mind are defaulted student loan payments. If you have a defaulted student loan, that is one of the worst financial circumstances that could occur. But during the pandemic and even stretching to now, most defaulted student loan borrowers have not had to make a payment towards their loans. They have not had to deal with garnished wages or garnished tax returns. In some states, they will even strip you of your professional licenses so that you can't work when you have a defaulted student loan. That is another area that the Trump administration has already said that they're upset with. So I would expect that student loan payments and wage garnishments and tax garnishments will likely resume in short order once the new administration comes back into power. Partial financial hardship is something that we're about to discuss literally on the very next slide. And then lastly, income recertifications. We talked about this briefly, but it's highly likely that if you're on SAVE or even if you are on another income general repayment plan that you haven't changed since March of 2020 when payments paused under the pandemic, that you haven't had to recertify your income and your current payment is based off of income from 2018 or 2019. A reminder, even if it is the right thing for you to do long term, such as switching from save to pay as you earn, you will have to recertify your income immediately if you switch plans. Versus if you stay under your current plan, let's say that it's not save, what the Department of Education has said is that November of 2024 is the earliest that you would have to recertify, but the actual date is going to be based on your IDR plan anniversary. This is another concept that we've talked about on the podcast. But let's say that the anniversary of your IDR plans when you typically recalculate your payments is in July of each year. Well, because they won't ask anybody to recertify before November, that means that you essentially skated this year and you won't have to recertify your income until July of 2025. But if your IDR plan anniversary is typically in December, because that comes after November, but it's still in the same calendar year, then you will have to recertify your income in this calendar year. So that's another consideration when you're deciding to stay on a plan or switch a plan, but at least you would want to have some idea if you've had a significant increase from then to now of how much that increase will be and when it will occur. You can find that IDR plan anniversary by looking at your NSLDS data file. We'll put resources for how you can find that file in the body of this email as well. Or you can go to your loan servicer and ask them for that month. So for example, if your payment was going to go from $300 to $600 a month, I would definitively want to know when that would occur so I can plan accordingly. But let's go into this concept called partial financial hardship. We've talked about this in a recent episode of the podcast, but the easiest way to describe it is if you sign up for an IDR plan and when they calculate your payment, what you would pay based on your income is higher than what you would pay under a 10-year standard plan. You do not have a partial financial hardship. And that's important because a partial financial hardship is required under the pay-as-you-earn plan and the income-based repayment plan. Now, if you're already on one of these plans, you don't get kicked off because you have a partial financial hardship. What would occur is they would revert your payment to a 10-year standard payment, and they would still give you credit towards student loan forgiveness. That means that there's a scenario where it could still make sense to stay on that plan, even if you're making a 10-year standard payment, because if you're pursuing something like public service loan forgiveness and you're not having that same payment for the entire 10 years, you still could have a significant amount of student loans forgiven, even though in this calendar year, your payment is technically what would be needed to pay off a loan in full under the standard plan. If you're looking on screen, we have a quick scenario that we use from the calculator for our guide to income driven repayment plans. We have a single person who makes $100,000 with a $75,000 student loan balance. You can see that under the pay-as-you-earn plan, in the new IBR plan, their payment would be $645 a month. But under the old IBR plan, it would be the exact same as the 10-year standard payment, which is $832 a month. That is because when they calculated the payment under old IBR, it was higher than the 10-year standard plan, meaning that this person did not have a partial financial hardship and their payment reverted to the 10-year standard plan option. So now, based on all that information, let's talk about some strategies for where you stand. If you have private student loans, this is where you come into play. If you are considering refinancing to a private lender, this is also where this information will be valuable. And as we discuss it, we're going to break you up into three camps. And you definitively, if you have federal student loans, you're a part of one of these three camps. You either have a federal or private student loan balance that is equal to or less than 1 times your household income. You have a student loan balance that is between 1 to 1.5 times your household income, or you have a student loan balance that is greater than 1.5 times your household income. Let's talk about some strategies for each of those three camps. starting with those who have a loan balance of less than 1 times your household income. And for this camp, the strategy, unless you have other pressing financial priorities, is to optimize the repayment of your federal or private student loans. I say that caveat because let's say that, the goal would be long term to pay off your loans in full for the least amount of money over the smallest period of time, but you do have significant credit card debt, or you are trying to take care of building up your emergency savings. Well, in that strategy, it may still make sense to take advantage of an income driven repayment plan, even though it's not the best optimized strategy for your student loans long term, so that you can focus on those other priorities. But once student loans have gotten on equal footing of your other priorities, it is highly likely that you're not going to have your student loans forgiven if you owe less than what you make on a yearly basis. Because going back to that partial financial hardship, as you saw on the previous screen, it's highly likely that you wouldn't have a payment under an IDR plan that would leave any remaining balance after 20 or 25 years. As a matter of fact, you may not even make it to 10 or 11 years. So if that's the scenario, instead of leaning on IDR, you would instead want to optimize your repayment strategy by finding the best combination of low interest rate and flexible repayment period and payment. Notice that I didn't say to find the lowest interest rate and the fastest repayment period. I said to find the best combination of those factors. The difference is the lowest interest rate and lowest repayment period may lead to a high payment that does not fit with your other financial priorities. You can definitively find a low interest rate if you're going to sign up for some 5-year repayment period. But if you're paying $1,500 a month towards your student loans and you're not able to save, you're not able to address your retirement needs, you're not able to pay down other debts, that's not the best strategy for you. It may be a better strategy to find a higher interest rate over a longer repayment period with a lower payment, because that allows you to both pay it off while also addressing other areas. Now, I will say that when it comes to federal student loans, in most times they have lower rates than what you would find with private lenders. And they also have more options and more flexible payment strategies when it comes to the ability to defer or forbear or income driven repayment plans, standard plans, and the like. However, interest rates on federal student loans are actually pretty high right now. And there are scenarios in windows like this where you could potentially find a lower interest rate with a private lender. And if the goal is to optimize repayment, there could be a scenario where it makes more sense to refinance that federal loan with a private lender. Or you may just say, and some people are saying this, even if it doesn't make the most financial sense, I am tired of trying to keep up with all this information going on with federal student loans. I just want to have this stuff paid off with a lender that doesn't change the terms and doesn't change the rules. And as a result, I'm going to refinance. That's not a bad strategy if that's something that gives you more peace of mind. If you are pursuing private student loans, there are some things that you want to be aware of as compared to federal student loans that work in your favor. Private student loans, they base your interest rate and terms off of a number of factors. Things like the SOFR index, which is something that they use to determine interest rates on a quarterly basis, monthly basis in some cases. They look at the credit score that you bring to the table and also the dependability of your income. And they also look at things like your cosigner's finances, if you have a cosigner. And if you had a cosigner in the past and you're trying to get them off of your loan, and I highly encourage you to do so, because if you were the person who took out the loan for your schooling, the cosigner has an equal responsibility to pay off that debt, which is something that if you have the ability to release them of that obligation, I would definitely consider doing so. If you co-sign for someone else and you need to get off that loan as fast as possible, when they have improved finances, they can actually refinance with a private lender that will release you from the co-signing responsibility, or the current loan that they have may have a co-signer release option, which you can investigate. It would require the primary borrower to submit information about their current income and credit. But if it is a strong enough profile, they could consider removing you from that loan, even without a refinance. Now, when it comes to the unique features of private student loans, there are a couple. The first, and I tell people who are either trying to refinance an existing private student loan or they have federal student loans and they're considering refinancing the private lender, I tell them to check rates for private student loans at least 3 or 4 times a year. And the reason that that is so easy to do is because unlike most forms of debt, where in order to get your interest rate, you have to have a hard pull of your credit, which negatively impacts your credit score. With private student loans, you can get a pretty good idea of what the rate would be if you formally applied through a soft pull of your credit. So that means that not only can you check interest rates frequently, but you can check with as many different lenders as you see fit, as frequently as you see fit, which is why I tell people whenever it comes to a form of debt that you're considering taking on, you want to apply with at least 3 different lenders. That is doubly true when it comes to private student loans because there is no negative credit impact when you apply with 3 lenders versus 7 lenders to see which can give you the best terms and the best interest rate. Another consideration when it comes to private student loans as compared to other forms of debt is that if you do decide to pull the trigger and submit a formal application, which would lead to a full hard credit pull, but you're getting a better fee, you're getting a better interest rate, you're getting a better repayment period, and maybe 2 or 3 years down the line, there's another scenario that pops up that is even better than your current student loan. Unlike other forms of debt, like a mortgage, where there's closing costs when you refinance a loan, with private student loans, there are no origination fees or closing costs, which means that you could conceptually refinance a private student loan 10 or 15 times. There's not going to be a negative financial consequence based on the amount that you owe because of those lack of origination fees. So if you're in the camp where this makes sense to you, that camp being you owe less than 1 times your household income in student loan balances, then these are the types of things that you need to consider. Next, let's go to camp number 2. These are people who owe between 1 and 1.5 times the household income. This is a camp that really has to make a decision based on what makes sense given the balance of their finances. Because the good thing that this camp has going for them is, at least when it comes to income-driven repayment plans, they are likely going to have a partial financial hardship. Now, the downside, however, is that if you have between 1 and 1.5 times your household income, there's also the distinct possibility that even though you have a lower payment under IDR, it's still going to pay off your loans before they're forgiven in 20 or 25 years. So by lowering the payment, you are giving yourself more flexibility in terms of your finances, but you're really just extending and paying more towards the student loans over time because of the way the interest accrues than you would by just paying it off in full under a more aggressive option. So if this is you, you really have to look at the payments through things like the calculators that we have or other ones online to figure out just exactly what is that gap between your IDR plan and a 10-year standard plan, or a plan that you would have available through a private lender versus just leaning on that lower payment to address other areas of your finances. For example, let's say that there's not much of a gap, but let's say that you do some calculations and your payment under an IDR plan is $150 a month less than it would be under the 10-year standard plan. But because that's still not that much lower, you do some calculations and find out that you're going to pay off your loans in 16 years if you continue making that payment. Well, in that scenario, I would consider it worthwhile to look at interest rates for maybe 15-year repayment plans with a private lender that might offer a lower interest rate than what you have on your federal student loans. And you may find that you can keep at that lower interest rate a payment that's very similar to what it would be under an IDR plan and shave an entire year off your repayment schedule while making the same payment because of the lower interest rate. Now, obviously, there's additional things to consider when it comes to leaving federal student loan umbrellas, like the flexibility that we've discussed when it comes to this debt as compared to private. But if you're within this window, this is what I'm talking about, where it is not as straightforward as just signing up for the income-driven repayment plan and forgoing all other options to the point of not even researching. And then lastly, people who owe greater than 1.5 times their household income. Because people in this camp are likely going to find that going the IDR route and aiming for forgiveness is going to save them a significant amount of money as compared to trying to pay it off in full, even with a private lender or the federal government. So if you can save $300 or $400 a month and you're going to have your loans forgiven in 20 years under pay, as an example, then it wouldn't make sense to pay that additional money to pay it in full over 20 years with the federal government, or even refinancing at a slightly lower interest rate with a private lender because of that huge gap between the payment savings under IDR. So if this is you, the strategy is to optimize the income-driven repayment plan payment that you are making. That optimization includes you choosing the right plan, making sure that you have direct loans only, because typically the most forgiving payment plans require direct loans only, and to consider public service loan forgiveness. We talked about it last night on the actual live version of this webinar. But I can tell you that when it comes to people with significant student loan debt, I think that the availability of public service loan forgiveness is often discounted. The one area where I don't see it discounted is in the healthcare space, where you see residents and fellows who really can just say, oh, well, all I have to do is do my residency, my fellowship, and then work for a nonprofit hospital or the VA for a couple more years, and I'm done. And then I can go, quote unquote, make the big bucks. But outside of medicine, I typically see people who are discounting the benefit of having student loans that you would have had to pay for 20 or 25 years forgiven after just 10 by working for a nonprofit or a government entity. So, yes, you may make a decent amount more working in private industry, but if you're telling me that that additional amount requires me to pay 500, 1,000, $1,500 a month towards my student loans for 10 or 15 years longer than if I just worked for a nonprofit or a government entity for 10 years, I'll take working for the nonprofit or the government entity. And I do see this, thought process where it's like, oh, I'll only be making half. That's not always the case. In some industries, that difference between nonprofit and private is not as pronounced as it is in others. So if you told me that I could make 150 for 20 years, but I have to pay for my student loans, or I could make 100 for 10, have the student loans forgiven and then go make 150 for the next 10, I'll take option B 10 times out of 10. So that's something to consider if you find yourself drowning in student loan debt and you're looking for a way out, a career change within the same industry, but with a different sector, public versus private, could be something that's in the cards. Optimization also includes making sure you use all the information we just shared to find the right income-driven repayment plan for you. And then also, once you have chosen your plan, understanding what helps lower your payment while also benefiting the other areas of your finances. If you're looking on screen, you're looking at a formula that shows discretionary income. Given your different payment plans, you're going to pay either 10% or 15% of discretionary income towards your loans each month. But that formula for discretionary income is adjusted gross income minus a certain percentage of your federal poverty level. Federal poverty level is a little too deep to get into on this call, so we're going to focus on reducing adjusted gross income, which reduces your discretionary income, conversely reduces your student loan payment. And there are some key ways that you can reduce your adjusted gross income that are available to any taxpayer. And those ways are what's called above the line deductions. Those are things like your pre-tax retirement contributions, be they 401k contributions, IRA, 403b, 457. If you're an entrepreneur, half of the self-employment taxes that you pay each year go to reduce your adjusted gross income. If you earn below a certain amount, the interest that you pay on student loans reduces your adjusted gross income. And if you have access to an HSA, FSA, or dependent care FSA, all of these things reduce your adjusted gross income dollar for dollar, meaning that if you have $5,000 worth of above the line deductions, it reduces your AGI by $5,000 as it does your discretionary income. And that has and can have an outsized impact on a reduced student loan payment. So if you're going to have it forgiven, you want to have it forgiven after paying the least amount possible towards the student loans. And this is one way that you can do that. So let's go into some of the questions that we had for this. One of the questions was, when exactly can I sign up for Pay As You Earn? Those applications are actually due to go live this week. In the recap email, we will put a link to the sign up page for income-driven repayment plans through studentaid.gov. If it's not working for you, then definitely in the next couple of days. But if you're looking at different announcements, those applications for both Pay As You Earn, and if for some reason you're signing up for income contingent repayment, they went live this week. Another question that we had last night had to do with having student loans and getting married and filing taxes with your spouse. So the person was asking, if I'm married and I have federal student loans, should I file my taxes apart or together with my spouse? We're not tax preparers, so I can't definitively give you that answer, but I can tell you what happens when you file separately from your spouse. First, if you file together, then your spouse's income is going to be included in your student loan payment for income-driven repayment plans. That's just what it is. So if you file your taxes filing jointly, then that person is now a part of the income calculation. If they earn a significant amount of money, then that's something that could lead to a significantly higher payment. And if they don't have federal student loans, it's something where it's at least worth considering filing separately. Because if you have a person who's making a ton of money, they don't have student loans, you're making a payment that's impacted by their income and they don't have any student loans at all. So something to consider. If you decide to file separately, the way that your taxes are impacted, which then impacts what's used to calculate your payment, depends on the state in which you live and whether that state is what's called a community property state or a common law state. I didn't have this information in front of me last night. That's the benefit, at least, of having to record this again. But the community property states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, and Washington. And those states have very unique laws when it comes to taxation. In those states, if you file your taxes separate from your spouse, instead of, like it is in all the other common law states, getting a tax return that just has what you earn. So an example would be in a common law state, if I earn $100,000, my spouse earns $200,000, we file separately, I would get a tax return that says $100,000, she would get a tax return that says $200,000. In community property states, it works differently. They put all your household income in a pot, in this case, $300,000. It doesn't matter who earns what. If you file separately, they just give you 50% of the income in the pot. So if I earned $100,000 and file separately, I'm getting a tax return in the community property state for $150,000. My spouse earned $200,000. She also is getting a tax return for $150,000. It splits it down the middle. So if this is a scenario and you are the spouse that earns the higher amount and you have student loans, that works to your favor. Because if I earn $200,000, but I have a tax return that says $150,000, that's what they're using to calculate my payments. This works even better if you have a stay-at-home spouse. If you earn $200,000 and your spouse didn't work at all, then now you get a tax return that says $100,000, which is really, really beneficial. However, if you're the spouse that earns $100,000 and you're getting a tax return that says $150,000, now you have to think about whether it makes sense, because not only is it increasing your student loan payment, but married filing separately in many cases leads to higher taxes for the taxpayer. So you definitely want to make sure that you do this in concert with a tax professional, because it is not as simple as just filing separate, taking the benefit of the payment. It could negatively impact your taxes if you're unaware of those consequences. So if you're watching this replay, I thought the webinar was very well received, but believe it or not, those are the only 2 questions that we had. So that's the end of the question and answer section. That's the end of this recording. I hope this information was beneficial to you. We will have this replay out to everyone who was live and also those who paid for the replay who weren't able to attend live last night. If you are listening to the podcast, and we are going to give you the option to sign up for this replay even after, because it's something that, at least until student loans change again, will be very relevant for people in the coming months. I'll talk to you soon.